Hey yo, bro. So he had this really good post earlier this week. It was like price running one standard deviation lower than Monday's low, and then you had this AM session giving bearish signals and a wicked read off of the first presentation from 4.8. And I was like, man, this is overlapping so much with measuring gap that I just feel like I have to say it. And the whole thing, measuring gap is it's like a ladder. It's just where or how price can move down, and just like a ladder, you can go down a ladder or up and up a ladder. So after we run through this Monday range and then we break down below the range to create this gap, London wicks up and we're getting into New York. And then in New York, we have this measuring gap. Measuring gap, fair value gap that doesn't get completely filled, especially on the 50%. So then you just plot the high, put the 50% on top of the 50%. So this 50% goes on top of the 50% of the fair value gap. And that will give you these measurements going all the way down, right? So these measurements going all the way down, just make it a little bit bolder. You can see you have this original consolidation, then you have these zero point 0.5 standard deviation, 1 and 1.5. And so the whole idea is like as price is working its way through these different levels, you're watching to see on lower time frames how it is going to read. So you take a look at the 5 or the 1 minute and you start to see how price is breaking through a level, revisiting it, breaking through a level, revisiting it, breaking through a level. And so I took this continuation off of that move just to get down to the last standard deviation. But as price is making its way through the ladder, it just gets to where it needs to get to. 1.5 seems to be the one that works the most often. And then just like a ladder, once it starts breaking the other way, you get that move up. So 15 minutes is giving you the measuring gap, 50% of the fair value gap that doesn't get completely filled. Price runs down, closes below the 1.5, and then on the lower time frame, the 5 minute or the 1 minute, you're looking to see how price then uses the same levels of the ladder, comes down, breaks through it. Nice read off of that 4.8 first presentation, breaks above the 1.5, touches it again, slams through this level up here, and then now the draw. So these were the other trades taking it out. The draw is back to the 50% of that fair value gap, just like in the market maker model. And so as price just kind of works both sides of the ladder, it's like, all right, well, I know that price just made this massive run. It went straight through the measuring gap. It went straight to first presentation from 4.8. It rejected and retested. It's going to retest here. And then this original consolidation is going to be a draw. It's either going to reject off the 0.5 and continue because that's an unfilled fair value gap, or it's going to bust through it just like it would in a market maker sell or market maker buy model. So you have that smart money reversal, which is happening off of that first presentation, but then using the ladder, that's how you can get those areas of where can I actually get in. So just lock this off now. So as price kind of works its way through, it jumps back through the ladder, gets to that 0.5, doesn't break through it. I mean, obviously we're in a bearish market. We are below Monday's low. We have this gap that keeps attracting people, but we see that we're rejecting below Monday's low. We've rejected below the previous day's low. And so as price rejects off of that measuring gap, it's like, all right, fine. Well, I'll just take that same logic and I'm working my way through. And then the counter argument is, I mean, it's literally the same. You take that first gap. Ideally, you want it to be a gap that does not get filled. But if you take the idea of the gap and you say the first gap is going to be that measurement, and let's just hide this, take that off now, then it's the same idea. Price will take that measurement gap 50%, project it out, and you don't just use it blindly, but you're saying if I can't get through that 1.5 and I start to reject, then what I'm expecting is I would expect to see price start to fail the other side, entry off of that 1.5. See, it happens twice here, breaks through it, retest it, breaks through it, retest it, breaks through it. If it can't even get through the original consolidation, that first origin, then we would anticipate price just doing the other thing and going the other way. So as it goes up, it breaks it, comes back down, doesn't retest exactly, but gets there and then chops through for the rest of the afternoon. Anyway, I just thought it was like, man, it's like the same stuff in different views or different lenses, but all the good stuff overlaps.